could go a little past 6 if anybody is able to, right? If necessary. I have a plan for today. If we finish before, cool. If we need to go a little past 6, I'm not opposed to that. Give me one sec again. Yeah, all right. Because I just want to talk you through what I have on the screen right now. Because I mean, same thing being said a bit earlier, that the exam is very close. It's the 9th of May, right? Which is 2 weeks from Friday. Yeah, yeah. So with the content remove. Oh, okay, yeah. Sorry, I keep in the COVID days when everything was online. Apparently, was showing on screen like my email inbox and WhatsApp and stuff, and apparently that's a big no-no. YouTube, not supposed to do that. Yeah, because you could reveal people's information, personal information. Right. Sorry. So I have 9 and you all 9 there. Okay, cool. No problems. Oh, cool. Right. So, folks, we are here today, April 22nd. We have class today and Thursday. And I was suggesting that we have class next week, Tuesday as well. But I'm thinking if you all could make Friday or if you can make the regular Saturday time, we could round out investment appraisal this week. And as you could see, because as you all know, before I had a whole second POA crash course for CSEC there. But I'm like, you know what? I feel like I want to give you all some time because, as we mentioned before, the exam is the same as the CSEC maths exam, and as you could see, I basically put them every day here, right after the CSEC POA exam, right? And to kind of fit you all in might be a little difficult, given that we have Caribbean studies here and then COM here. Right now, of course, after COM, you might come through and say, hey, let me just beast out stuff, right? Now, there's a real tough call for me to make because I like to spend the evening before the exam with the respective set of students, right? If I could manage to get all these 8 sessions in, I'll see if I could leave the last 2 sessions in my assistant's hands and maybe bring you all in the evening here, right? But just a point to note, right? Counting today, hold on, sorry, I forgot, I froze the panes, right? Right, so for April, right, we had our regular Saturday class 2, and then we had 2 last week, that's 3, 4. So we kind of at our quota in terms of what the fees will cover. I'm putting on the next today and Thursday and the 3rd session at no extra cost, right? So the fees will remain unchanged for April up to that point, right? For this stuff here, I have 6 sessions planned. If I could fit in a couple more, maybe like if I could put you all here on the 4 to 6 slots here, or whatever the case is, or maybe 4 to 6 and then half 6 to half 8, whatever the case is, right? That set of classes will have to attract a different cost. Again, I'll try my best to keep it at the usual 400, and we'll count those fees as fees for May. All right. So whatever was due for April will have to come through for April, if not already sent, and we'll cover everything we'll do this week, right? So even though that these classes will be in April, we'll count them for May. So that way it wouldn't be like a huge double amount, right? Because we didn't discuss that up front with the parents. So that would be kind of unfair to spring on them, right? So I'm not gonna do that. 1 second, let me just freeze these panes again here. Right here. Here's Elijah. Hey, afternoon, Elijah. How you doing? On? Yeah, cool for you. We're just discussing some logistics, right? So, right. So for this week, we're doing today, Thursday, and I'll send a poll to see if you all want to do Friday or Saturday. I can't promise to do both, right? And then next week, well, I guess I can mark it. This is a crash course and see if anybody just want to tag in. But like I said, I already have one young lady who paid for the crash course, but that was based on like 12 sessions, and now it's cut down to half of that. So I clearly have to send some money back for it. Anyhow, right. So you can let me know what you think of that particular plan. So the plan for these 6 sessions would be that each pair of sessions would be basically doing as many past paper questions as we possibly can on question like, okay, so these 2 sessions will be question 1 only, these 2 will be question 2 only, and these 2 will be question 3 only, right? Now, I mean, we've done a lot of question 3s, question 3 content recently, including what we're going to be doing today, Thursday, and either Friday or Saturday. But I mean, we want to revise it, obviously, right? Unless, of course, you'll figure, well, no, we're good with module 3 because we did it past couple of months. So just focus on modules 1 and 2, right? If you all want to do that, you could let me know. Or we could do like module 1, start module 2 here, end here, and then do a couple of sessions on module 3 down the line, right? We could do that. But again, we could discuss that because I prefer to discuss it with you all and find out what you all want to do. Because I mean, I don't know what else you guys have going on. I mean, I know I have Caribbeans that you all have Caribbean and come here. I don't know who else has anything going on apart from that. Sorry. Right? And then the paper 1 is the following week. And as you can see, they have my ad maths class here, but I have my assistant currently taking over my ad maths class. I wanted to spend that time with them, and as you can see, my Form 4 staff, but I could cancel them, right? And then the accounts for CSEC multiple choice is the following week. So this timetable just it really didn't, right? It didn't facilitate me sharing of myself as I would like to. But anyhow, right? I definitely want to do sessions with you all here. You all could, I'll take a poll in the chat to see what you guys have going on here. Yeah. We're gonna overview of the syllabus. Yeah, but like I said, basically what I plan to do is I plan to do that via the past papers in these sessions here, right? And then for the multiple choice sessions, again, we could, even if we do those in May, we could cost it for June because the last hurrah for the paper 2 will be at the end of April. But we already had sessions for April, so we'll cost that for me and that kind of stuff, right? But I had to send messages out this week to parents regarding that particular set of logistics, right? Anyhow, folks, we're already a bit late, so I want to start the work. All right, cool. So let me pull up my stuff, right? So, folks, the last topic we have to do is investment appraisal. All right, investment appraisal. So I kind of break in my rule a little bit here, right? Right, so capital budgeting or capital investment appraisal, right? So basically what we're going to be doing with these is analyzing the feasibility, the financial feasibility of long-term projects, right? So it's a collection of techniques used to assess the financial viability of long-term investment projects, right? Construction of new buildings, purchase of new plant equipment, etc. Right? So we have 6 items to discuss. Today we'll be doing the first 2, payback period and accounting rate of return, right? Thursday, we'll be doing net present value. I like to kind of couple that with the discounted payback because they kind of play off each other, right? The profitability index is kind of neither here nor there. You barely even see that, right? And the IRR is also something kind of tricky, which you don't bring often because of the nature of it, right? But it's not impossible for them to ask, right? So today, we're going to be discussing a couple of these things here, right? The first 2. So what I want to do, I want to send this as a pick in the chart. Oh, no. I have my POA crash course people at the top there. Right, so you have your techniques there, right? So, no, what am I doing? Don't want that. Right, yeah, so, I mean, I had a bunch of notes already put in there. You can see I did leave some, but I'm not going to leave all, right? Okay, cool, so let's talk about it. Sorry, autograph by B, net book value. Net book value is the difference between the cost, the historical cost of an asset, the non-current asset, and any depreciation already charged on the asset. That's what net book value is. Tell Aditya, Rudra, Vidi, Gopal. That's the answer. Right. Cool. So payback period. So as the name implies, is a period is a length of time, right? And the payback means that, well, basically you're gonna get back money, right? So as you can imagine, when we spend money on these projects, we want to know, well, how long does it take to get back the money, right? To kind of break even, right? So what a payback period is this is the length of time. Sorry, 1 second. It takes for a project or investment to recoup or earn back its initial outlay, right, or the cost of the project or investment, right? So the basic rule of thumb is that if the shorter the payback period, right, is the more attractive the project is, the faster you get back the money, is the better it is, right? Now, very, very important, right? So this method is based on, cash follows, right? Cash flows and not profit. Right, it's very important. Right, so let's do a quick example. So example 1, right? A firm is considering investing in one of 2 available projects. Okay, so project A. I O is the initial outlay, right? That's equal to 800,000. And project B, let's go. Right, so they have the same initial outlay. That's the first observation we have, right? So it kind of makes it kind of like an even call, right? Right, so the annual net cash flow associated with the project. So net cash flow can be abbreviated NCF, right? So the annual net cash flow associated with the project is equal to 160,000 per year. Right? The annual net cash flows with this project, right? So in year 1, we have $100,000, right? Oh, sorry, I forgot to say, this is for project A, is 160,000 per year for 10 years, right? Right. Now for this other project in year 2, we have an inflow of 300,000. Year 3, we have an inflow of 500,000. Right, and in year 4, we have an inflow of, yeah. Let's just put 600,000. Actually, just leave it at that. That's fine. Right. Okay, cool. Right. So we have 2 projects available to us, Project A and Project B. Both have the same initial outflow, but the timings of the inflows are, of course, different, as we can see here. All right. Sorry, give me 1 second. Let me just tell Sarah good afternoon. Hey, Sarah, good afternoon. How are you doing? Today? Yeah, no worries. I was a bit late myself. Don't worry about it. So we're discussing investment capital budgeting or capital investment appraisal today. We have about 6 techniques to discuss. We have class today, Thursday, and either Friday 4 to 6 or Saturday usual time. We have to decide. And then next week we're gonna do a bit of a, I don't like to say crash course, but yeah, we're gonna do all day Tuesday, like from 10 o'clock to 8 o'clock, and then Wednesday we can do like 10 to 3. All right. Right, and we'll see if we could fit in a couple extra sessions thereafter, but I can't promise that, right? But I don't want to leave you all high and dry after we finish this topic. We have stuff to do. Okay, just giving you guys a heads up. I'm expecting a little delivery of food, so I will run out at some point to get it. Okay, right. So once again, we have 2 projects available. project A and project B. And we have to choose. We only have enough money to finance one of the projects, right? So we need to see which one is better. And of course, to measure better, to compare them, we need metrics, right? We need some kind of way to compare them. So this payback period is talking about how long it takes for the project to pay back itself, right? Sorry, to pay back for itself. So you have to, of course, have information sorry, to facilitate that calculation. What we need, of course, is, well, how much money does this project earn? Now, we also have to be mindful it's based on cash flows and not profit, right? So we need cash flows, okay? Some questions can give you profit and you can work backwards to find out the cash flows. We're supposed to see one of those examples a bit later on. But for right now, let's go back here, right? So project A is paying us $160,000 per year for 10 years. Project B is giving us these mixed cash flows here over 3 years, all right? So let's take a look and see how we would do this. Now, for the first item across on this side, right, it's kind of easy. When I say, if you're getting back $160,000 per year, how long until we earn back $800,000, all right? So let's take a look. So payback period will be equal to, right? So we'll take the initial investment, 800,000, and divide by 160,000 per year. Right? And 800 divided by 160 will actually give us 5 years. This project takes 5 years to pay back, right? Right. And oh yeah, and this project, by like I mentioned earlier, this project has uniform or even cash flows, right? And this project across here has uneven cash flows, right? So when you have a project with even cash flows or uniform cash flows, it's very nice and easy to calculate the payback period, right? You just have to divide the initial outlay by the annual net cash inflow, and you get your answer. Simple and straightforward, right? So what I want to do, I'm going to send a picture of this in the chat. Sorry, hold on one sec. Okay, sorry. I thought I saw somebody message. I went in, I did not see a message from the person. To be able to average that. Crop. Right. So the question now becomes, how do we therefore calculate the payback period for a project with uneven cash flows? Well, it's a longer process. It's not super long, right? But this is how it's going, right? So payback period for project B. Okay, cool. So there's no one right way to lay this out. What I'm going to show you here is just the way I decided to do it today, and technically last year as well, and the year before that. Right. So we're going to have the annual net cash flow, which I'm just going to abbreviate as NCF for net cash flow. Sorry, give me one sec. Yeah. Sorry, Charmaine. I am not familiar with the MOB syllabus, so I can't tell you yes or no. And Shaf, you, what vibes? Yeah. Yeah, sorry about that, guys. So yeah, and then of course I have the balance. Right, let's put that there. Okay, so the initial outlay is 800,000, right? Sorry. So the balance after that you have to pay back is 800,000, right? Cool. So we have a balance of that. Right now, we have to minus every time we get paid back, right? We have to subtract to see how much is left. Because remember, what are we trying to do? We're trying to see how long it takes to get back 800,000. Okay, how many years, right? So we're going to minus the net cash flow in year 1. Right, so that's how much? That's 100,000. Right, so I'll pull in from here, right? Why is that in bold? Right, so it's equal to 700,000 left. Okay, cool. Right. Less net cash flow in year two. Right. So that is 300,000. We have 400 left. Now in year three, we could see we have 500,000 coming in. So we know it's going to pay back, but it's not going to take the entire year to pay back, right? Because as you can see, 500,000 is more than 400, right? Right. So yeah, clearly it pays back for itself and then some, right? So how do we therefore convert this to something? Yeah. How do we convert this to something a little more meaningful? I guess you could say. Because clearly it takes almost 3 years. We want to be a little more precise because we have a 5-year figure here, right? Let me shift this up, right? So the payback period is equal to 2 years plus, right, 400,000, sorry, divided by 500,000. Sorry, that's not supposed to be right? So that's about 2.8, right? So that's equal to 2.8 years, or 0.8 by 12 is 9.6. So yeah, you can say. So 2 years, 9.6, or 10 months, if you want to be a little simpler, right? So that's what we would do. A little bit more. Right. So I think I sent piece of this already. So I'm gonna send everything again. Everything that's currently visible. Okay, cool. Right. So Mario, no, this has been on the Cape Accounting Unit 2 syllabus since inception, back in 2001. So no, it's not you. It's not you. Right. Okay. So my class, my Google Meet people, if you'd be so kind as to give me a G, if you're good with what I've shown you so far about payback period. Right? If you need me to recap or re-explain anything, that's not a problem. I have a little note to give you again. All right, but yeah, just give me a quick G in the chat if you're good with that. Usual thing. Hey, Miriam, how are you doing? Good to see you. So I'm not seeing Aaliyah. Right, okay. I just try to update my role. Elijah came. Right. Joshua, Keisha, Carrie Ann. No. Right. Okay. Cool. I just put one here. Right. Okay. Cool. So right, I could put this down, that up. Not really followers. Right. Okay. Brilliant. Okay. So I just have a little note to give here. Sorry. That's here. I didn't check for the R. No. Okay. Cool. Okay. So now, after you calculate the payback period for both of these items, you have to make a statement, and your statement has to be talking about which of the projects is more attractive based on what you've calculated, right? So of course, we're looking for the project that pays back faster, right? Now, of course, you can have more than 2 projects, right? Sometimes you might only have info for 1 project, in which case you just want the payback period. You're not comparing it. You just want to know, hey, what's the payback period for this particular project, right? Okay, so here, based on the calculation above, right, project B is the more attractive. Sorry, I'm gonna have 2 eyes there. Attractive of the 2 projects, of the 2, right? As it has the shorter payback period. Sorry, one second. My wife said something. I gotta check in case it's already big enough. Right. Project B is the more attractive of the 2, as I showed the payback period. Than project A. So faster, right? right? 2.8 years. This is 5 years. Cool. Right. Now, again, it seems very simple, and that's actually one of the advantages of this particular investment appraisal technique, right? It is relatively easy to calculate, right? And calculation of cash flows is more objective than calculation of profit. What I mean by that is, remember, when you're calculating profit, you're using the accruals concept, and you're talking about sorry. Okay, cool. Yeah. So yeah, you're talking about depreciation. You're talking about accruals, prepayments, allowances like depreciation and provision for bad debts, and other such estimates that are non-cash in nature, and again require estimates which can be subjective. Cash is not subjective. You know how much money coming in because you could count it, right? If it comes into your account, you could see by how much your account goes up. Simple, straightforward, no hullabaloo, no what ifs, no kind of analysis. How much you get? This much? Cool, right? So again, relatively easy to calculate, and cash flows are more objective than profit, right? The calculation thereof. Now, the disadvantages. Now, of course, books might give you more advantages and more disadvantages. I like to give 2 or 3 each, right? So this will only make sense when we talk about the net present value, sorry, right? It's actually one of my favorite parts of the syllabus, right? It's a little more math-based. Right? And this is a very important one. It ignores inflows after the payback period. So let me talk about that a little bit more, right? So we noticed that Project B had 3 years of inflows, right? Now, if we just take raw addition, 100 plus 3 is 4, 4 plus 5 is 9. Cool. If you take Project B, now Project B takes 5 years to pay back, right? But look at it. It's given payback it's creating cash flows for 10 years. How much is it making in each year? 160. Let's do a little calculation, right? 160,000 multiplied by 10 is 1.6 million. Now, again, this ignores the time value of money. It's just a raw cash figure, right? Now, 1.6 million over 10 years is more than 900,000 over 3, right? I mean, it's a bigger average here. You get about 300,000 per year. Here, you're getting like half of that per year, but you're getting it for like 3 times as much, more than 3 times as long. 10 years versus 3, right? I mean, I don't know about you, but I think I might rather get 1.6 million over 10 years than 900,000 over 3. All right. But again, it depends on your goals, your objectives, different things in the economic environment, short term, medium term, long term goals, right? So that's what I mean by the payback period ignores inflows after, right? So once you earn back your money, you stop counting. But of course, you can't ignore the fact that you're getting in, how much is that? We said, 1.6. Yeah, 700,000 more dollars flew in. I mean, over the course of 7 more years, right? As opposed to 900,000 here, right? So that as an issue, right? You shouldn't really ignore that, right? But again, you're not looking at that. You're just looking at how long does this take to pay back, all right? Okay, cool. So that's payback period in a nutshell, to be honest. So of course, what I want to do now is I want to give you guys a question to try. Okay. Let me send this item. Sorry. Where you all? I keep. Right. So right here. All right, so I'm going to pull up my next page now. All right. Of course, I am going to zoom in so you guys can see the question a little more clearly. Okay, so this is from my UV text, right? So Summer Recreation Inc. uses the payback method to evaluate major new attractions for its amusement parks. Company policy is to accept projects that have a payback of 3 years or less. The firm has been looking at a $1 million ride called the Whiplash for its Tennessee facility. The Right as a 5-year service life and is expected to generate the following additional cash inflows. So that's a very important piece of information, cash inflow, right, over 5 years. So 4, 3, 2, 5, 2, 1. Okay, cool. So we have uneven cash flows. So we're going to have to kind of use the slightly longer method where we subtract as we go back, right? Again, you don't have to do it this particular way. If you already have a way from school you like to do it, by all means, you can use that. All right. Okay, cool. So long story short, what I want you to do is essentially calculate the payback period and state whether we would accept. All right. So basically, basically we're just doing part B. Calculate the payback period and state whether the Summer Recreation Inc. should accept or reject this investment. Sorry. Oh, hi, good afternoon. Oh, no, it's the mouse on the right. So, Very good. Food came. I don't know if it's my phone, but like the Wi-Fi keeps dropping from my phone. It's not from this. I good. Yeah. So when you have mixed cash flows, it's a little trickier to organize the business. But let's take a swing at this one, shall we? Summer recreation. Let's zoom out a little bit. um, Summer recreation, right? Calculation of payback period. Okay, cool. So, year, what we like to call year zero is when we're making the initial investment, right? It's $1 million, right? So you can put a million here, it don't matter. Again, there's no one right way to do this. So then we have year one, right? So you have 400,000. Year two, you have 300,000. Year three, you have 250,000. Year four, 200,000. Right. So I think for this from eyeballing it, like this was 950 already. So you didn't have as much, right? So is this minus that? Right. So after the first, say you have 600,000 left. 600 minus the 3 will give us 300. 300 minus 250 is 50, and then 50. Right. So as you can see, in the fourth year, it pays back for itself. But therefore, it takes 3 years and a little bit. So we want to calculate what that little bit is. All right. Cool. So let's go. So the payback period, therefore, is equal to 3 years plus, right? So you have 50,000 to get back, finish payoff, and you receive 200,000 in that year, right? So 50 over 20, 50 over 200 is a quarter, so that's 3.25 years, or 3 years and 3 months. Right, cool. But, what was the policy? Company policy is to accept projects that have a payback of 3 years or less. So guess what? Even though it's 3 years and 3 months, it's more than 3 years. So based on the criteria, acceptable unacceptable. Years, this project should be rejected as its payback exceeds 3 years. Cool. So I'll send a picture of this in chat too. Up to date. Right. So what about you guys? Did you guys get that? If you got that, if you're good with that, give me a Genie chat. If you need me to re-explain, re-evaluate, give me a R. R. Lovely. Okay. Cool. Cool. Right. Uh-huh. Well, that's just to find out what fraction of the final year it took to finish payback, right? So the first 3 years, right, paid back piece, but didn't fully pay back. And what happened was the balance that we had outstanding at the end of year 3 was less than the amount of cash we were getting in year 4. So what we assume that the cash accrues what we call uniformly over the year. So what that means is that, so let's assume for the sake of simplicity, this was 240, right? So that means you would get about 20,000 a month, right? So basically what would happen is at the end of the first month, you get 20. At the end of the second, you have a next 20. So 20, that is 40. And then halfway through the third month, they earn the next 10,000. So that's how we have 2.5. Yeah, so almost 3 months basically, right? So what I did in order to find the fraction of the final year was I took how much was outstanding at the end of year 3, at the end of the penultimate year, put it over the total inflow, and that gives me the fraction of the final year. And to find the number of months, I would just take this fraction and multiply by 12. Right? So if I took 0.25, right, I multiply by 12, right, I would get 3 as months. Right, so yeah, so I put the 50 over the 200 to get the fraction or piece of the final year that would make my answer more accurate than just putting 3 years. That clarifies. Okay. All right, so there's the next one from the text. Let's see what we're seeing here. Right, so this is payback and accounting rate of return. We will do this question first, and then we will double back and deal with accounting rate of return. This is 27.8. Yes, no. Okay. Right, 27.8. Oh, okay, yeah. So we'll discuss ARR after. Okay, so this question has a little bit of a twist in it. So let's take a read and we'll see what's going on, right? So payback, right? So Instant Change offers 10-minute oil changes at numerous facilities in Kansas and Nebraska. Okay. The company wants to expand into Illinois and has picked a site that is expected to have the following annual results. So basically what you have here is like a little income statement. Sales revenue, 310, right? OpEx, oil and supplies, wages, insurance, utilities, depreciation, totaling 235, and the operating income or profit is 75. Now, land acquisition and building costs for the Illinois facility will require a 500,000 initial investment. So that's your 500,000 initial investment. Okay, cool. Disregard income taxes. Income taxes actually require adjustment. Right now, I can't even tell you how to explain that because what happens with income taxes, when your expenses go up, your profit goes down. Your profit goes down, tax goes down as well. Right? So with each expense, there's a tax saving you have to factor in. But again, that's not on your syllabus. You don't have to worry about that. I'm probably making it sound harder than it actually is. It is a bit math based, but again, when you see it and it's explained properly, it makes sense, right? Right now, we're not doing that, so we're going to just disregard. Okay, so it says if management desires a payback of less than 6 years, should the Illinois facility be opened? Why or why not? Right. So what we're seeing here is that we have an initial investment of 500,000. But what we're given here is not cash flow. We are given profit. So the question is, how do we therefore convert profit to cash flow? And what we have to do is undo any non-cash items. What does that mean? Okay, if we go through our income statement, so sales revenue is cash, right? Oil and supplies, well, I mean, you're paying for oil and supplies, you're paying wages, you're paying insurance, you're paying utilities. Are we paying depreciation? No. Depreciation is a non-cash expense. So what do we have to do? We actually, how do we undo any non-cash things? Well, think about it. If we eliminate the depreciation, let me see, can I get a, right, insert, yeah. If we take out depreciation, format, what's the weight on that boy? Wait, look at it, wait. Let's do two, one quarter, that's fine. Let's change the color, right? Let's put it in red. Why not? Right. So yeah, so you're going to take out depreciation, but that means that this 235 is going to go down, right? Because 235 was the total, including the 25. So that's going to go down to 210. And when you subtract 210 from that, you're going to get 100. I mean, the easier way to do it is just to add back the depreciation. So that's actually a shortcut, right? So what I'm going to tell you to do is you're going to head up instant change calculation of payback period. Right. So you have your initial investment of 500,000. And like I said, basically what you're going to do is, because the depreciation is the only non-cash expense. So to undo the effect of depreciation, you're going to add back the depreciation figure to the 25, giving you 100. And if you notice, it's the same figure every year, right? Over however long. So because we have now even cash flows, you can simply divide the 500 by the 100, all right? I'll give you a couple minutes to kind of see if you can put that together. Put that right here. 1, 2, 3. Right. Skip a line. Right. So let's head up annual net flow. Right. So operating income, add back depreciation. Right, so that's the figure you're going to put in your calculation up on top of here, right? So that there is one of the tricks I like to bring, right? They might give you this net income thing, the income statement, or some kind of profit thing, and you have to know, hey, profit isn't cash based, so I have to send it from profit into cash by adjusting for any non-cash items, right? Right. If there was any non-cash inflows, I can't even think about what one might be, to be honest, right? You'd actually have to subtract that, right? You have to take it out of your profits, right? So, but any non-cash expenses, you add back. Any non-cash revenues, you subtract. 500,000. Divided by the annual net cash inflows. Right, which is 100,000. So in this particular case, we have a very simple calculation: 500,000 divided by 100,000. That gives us 5 years, right? So the payback period in years. Okay, cool. All right. Ladies and gents, can I get a quick G in the chat if you guys are good with that, please and thanks. If you need me to re-explain anything, give me an R, that's not a problem. Okay. So 9 out of 11. Okay, not bad. Thanks, guys. All right, cool. So far, so good. All right, Faith, good to hear that. Lovely. Okay, so now that's basically it for payback period, to be honest, guys. What we're going to take a look at now is the accounting rate of return. So I basically copied and pasted the same question across here, right? So the information is the same, as you can see, same instant change, blah, 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 right? So what I'm going to do is I'm going to give you the formula for the accounting rate of return, okay? Right, so the accounting, rate of return is equal to, so this is where it gets interesting, the annual increase in net income, or net profit if you prefer that word, divided by the initial investment, multiplied by 100 over 1 equals to X percent, some percent, right? Basically, if you guys remember like anything from your Form 5 or maybe your Unit 1 if you did it, and you think about your ratios, there was one called the return on investment, where you took your net profit and you divided by your capital invested or your share capital or what have you, right? So here, basically, we invest in some money. We invest in a 500,000. What are we getting back in profit every year? So it's literally a return on investment calculation. All right. So I know for those who didn't do Unit 1, or even if you did it, that might be a long time ago, might be a little rusty. And for those who, if it was just CSEC, yeah, CSEC was quite last year. You had a whole July, August between when CSEC ended and when Form 6 started. So you might not remember your ratios, right? But basically, all it is you're taking the return, right? That's why it's called the rate of return. A return is what you get back. So you invested 500,000, and every year the investment is paying you 75,000 in profit. All right. Now we have one little thing to add here, right? Right. So sorry. So sometimes, right, the average investment is used as the denominator, right, in the above calculation. Now, how do we get average investment? To find the average, well, you need at least two things to find an average. So you add those two things together to get a total divided by 2. And you kind of even out the difference, right? If it was 3 things, you add the 3 things together, divide by 3, and so forth and sundry, right? So how do we do this, right? So the average investment is equal to, right, the initial outlay plus the residual value divided by 2. right? So why the residual value? Because the initial outlay is how much it's worth at the start, right? The residual value is what is left at the end. So you have your beginning value, you have your ending value. It could be zero for all we know, right? It could be, we could totally depreciate or wear out the item and have no value left attached to it, right? It could very well be zero, but the question will have to tell you, right? So you might spend some money on something and have some value left in it. So you add them together and you divide by 2, you average it out. All right. Okay. So how do we do this? Yourself. Right. Okay. So let's take a look, right? Sorry, one sec. So what? Okay, so from the above question, right? So let's see what we have, right? So we need ARR is equal to the initial investment, sorry, the annual increase in net income. So go back on top of here. Let's see if we could freeze the panes. Sorry, not freeze. Let's see if we could actually split. Right. Yeah. So the formula is annual increase in net income. Okay, cool. Right. So annual increase in net income is 75,000. And we have to divide it by the initial investment, which is 500,000. And of course, we have to express that as a percentage. We multiply by 100 over 1. That's going to be equal to, sorry, what did I do there? Yeah, that's going to be equal to 15% exactly. Right? So if it is just a using 75 over 500, as in just the initial investment, you're good to go. All right. If, however, we are using what you call it, the average investment. Now, here, they didn't tell us anything about the average and about the residual value, right? Let's see. Yeah, okay, cool. Sorry. What? Sorry, let me just. Okay. Yeah, so if we're doing initial investments, sorry, average, right? So using average investment, right? So again, if the question isn't explicit as to if there's a residual value, you could assume zero. We only have an initial value, right? So if that's the case now, one sec. Ooh, no, I don't have that space, do I? So ARR will be equal to. So the same annual increase in net income divided by average investment, right? So the average investment is the opening value, which is the 500,000 plus its ending value, which is zero. Right? Again, it's just an assumption I made. Right? So basically what we're going to have is you're going to have 75,000 over 250,000. Of course, you're going to multiply that by 100 over 1. Right? So that's going to give us 30%. Cool. Yeah. Out a little bit so we can fit everything in one pick. Right? So again, the accounting rate of return is simply a return on investment. What percentage of the initial investment are you earning back as profit every year? So you take your annual average increase in net income, you divide it by your initial investment, and you simply get that as a percentage of said initial investment, right? And again, if you have to use the average investment, this should give you a residual value. If you don't get one, you could assume zero. Right. Okay, can I get a sir? Okay, cool. Residual value. So basically, what it is let's say I buy a car today, right? And I plan to, and let's say I paid, let's just take a figure. Let's say $180,000 for the car, and I plan to use it for 2 years before I sell it. And when I sell it, I plan to sell it for 80,000. So I'm planning that car will lose 100,000 in value between when I buy it and when I sell it. So the residual value is simply an estimate of the value of an asset at the end of its useful life. All right. Fit that somewhere, boy. Just a second, Let me see. Can I? So residual value is an estimate value of an asset pull down clearly. I just had to resize the print area. Give me 1 sec. Let me just automatically fixed. Okay. Great. Oh no, it didn't. It didn't. Hold on 1 second. Okay, sorry. Going back in. Yeah, so residual value is an estimate of the value of an asset at the end of its useful life. So basically the value after depreciation, yes, that is exactly what it is. Cool. Okay, cool. So let's give you guys a question to try. All right, so in this question, give you a little bit of a help out at the start. Yeah, no problem. You're welcome. All right. So let's hold on. I did send that item, right? Yeah, I did. Okay, cool. Without the note. Okay. Right. Let's send a picture of that. Okay, so I'm gonna zoom in, of course, because I mean we gotta see what's going on. All right, so let's take a little read of the question, and we'll take a little swing on what we have. Right, so Tasty Treats is studying the acquisition of a new vehicle to expand its fleet of ice cream trucks for service in suburban neighborhoods. Okay, so they're trying to buy more ice cream trucks, right? Non-current assets, cool. So this is a prime candidate for investment appraisal, capital budgeting techniques, right? So the truck, which has an 8-year service life, a 2,000 residual value, right, is expected to cost $20,000. So right away we get estimated useful life, 8 years, residual value 2,000, and most importantly, initial outlay of 20,000. The company's owner anticipated annual sales will increase by $25,000 if the truck is acquired. Annual operating costs will be gasoline to $2,000, license $100, maintenance and repair $1,200, driver's salary $68, and insurance $900. The cost of ice cream generally averages 40% of sales. Ignore income taxes. and they wanted to calculate the annual net cash inflow, right? So basically, what they want you to do is just like how they had this thing here for the previous question, right? This item here, hold on. Yeah. So I can't, hold on, can I box it off? 1 second. Sorry, my apologies. Of course, that was not what I wanted to do. Shape fill. None. No fill. Thanks very much. Right. Outline. Yeah. Right. Yeah. So this here, basically, what they want you to do is this thing here, right? Now, my advice is leave out the depreciation. Now you're gonna need it when we're doing ARR, but we're not doing ARR first. All right. Right. So what I want you to try do first here is I want you to do this with all the depreciation, right? So you have your increase in sales 25,000. You have annual operating costs. So all these are cash based. Gasoline. You got to pay for gas. You got to pay for your license. You got to pay for maintenance and repair. You pay for your driver's salary. Pay for insurance. And this piece here, most people forget. The cost of ice cream generally averages 40% of sales. That's your cost of sales, right? So you're gonna find 40% of 25,000 and minus it to get your gross profit, right? Okay, so I'm gonna give you a 5 minutes to see what you come up with, right? And they want in net cash inflow, all right? So I'll give you a few minutes. Right, cool. Okay, lovely. All right, cool. Let's see how this one. Just zoom out a little bit. I think we could do like a 140 on that. This piece, everything will increase. Okay, cool. Well, big? No, I think we okay. All right, cool. So calculation of annual net cash inflow. Okay, so we're going to start with the increase in sales, right? So annual increase in sales is 25,000, right? Less cost of sales, 40% of sales. Right. Boom. So your your gross profit, right? Right. So after you cover your cost of sales, your cost of goods sold. Oh, I didn't highlight. After you cover your cost of goods sold, right? You have this here to cover your other expenses. So that's operating annual operating costs. Cash. Okay, so what we have gasoline. So that's how much? 2,000 for the year. Of course, these figures are made up, so don't think that the person only paid 2,000 in gas pay. I mean, maybe way back in the day, right? So licenses. The real Trinity thing, I'm pluralizing everything that don't need to be pluralized. Water cokes, right? So maintenance and repair. Right, 1,200. Driver's salary, right, 1,600. Insurance. Okay, gonna add all those up. 11,000 exactly what it was. All right, cool. Subtract that from the 15. That is the annual net cash inflow. Cool. So let's zoom out a little bit so you can get that. All right. Can I get a quick G in the chat if you guys are good with just that piece? I'll be doing it piece by piece because I think it's important to work it piece by piece. As it's something new, right? And it's literally a lot of moving pieces. You need to re-explain to me R is not a problem, huh? Right. Okay, cool. Now with that, given this, right? What I would like you to do, I'd like you to calculate now the payback period. So remember this item here. Let me see if I could just highlight that, right? Let's do a highlight. Let's do it in a green. Right. Right. Okay, cool. So that's the cost, and that's the annual net cash inflow. So it's a constant inflow. So we know it's a simple division. So organize that for me quick, and then we will shift gears and do the ARR. go. Right. So we're gonna do sorry. Right. So there's no calculation of payback period. That stuff is it too small? I guess a little small. Yeah. All right. Cool. So we know it's 20,000, right? So this is the initial investment or initial outlay, right? As 20,000, and we have to divide by the annual net cash inflow, which is 4,000, right? Divided by that, which is okay. I guess we could leave it in that. That's fine. Right. So this is the payback period. Right. Right. Cool. So I'm assuming we're good with that. If you're good, cool. You don't want to give me a G. If anyone needs me to react, give me an R. Right. It's cool. Right. Now we have to now work on the ARR. To find the ARR, we need the average annual increase in profit divided by the average investment, right? So we're going to use average investment this time, right? So for the average investment, we know that it's going to cost 20, residual value is 2. So we have to find the average of 20 and 2, right? We need the annual net annual increase in profit. Now, what we found on top of here with the 4,000 was cash. We need to adjust it for depreciation. So we're going to have to calculate depreciation and subtract it, right? So here what I want to do, you have to calculate the following, right? We need the average investment. We need the depreciation. And we need the annual increase in profit. Right? So the average investment would be, that could be the last thing. It doesn't matter what order you do it in, right? But you would need all of that stuff to kind of get the ARR, right? So for the annual increase in profit, you're going to need to take the depreciation away from this piece here, because it was the only expense really missing from here, right? And we left it out because we had to calculate cash, right? Net cash flow, right? And depreciation, as we know, is a non-cash item, so we omitted it. But now that we want profit, we need to put it in, as in included in the calculation, which means subtract it, right? Now, the depreciation is under the straight line method. So we're going to need the cost minus the residual value divided by the estimated useful life. Yes, right? We have the 20, which is the cost, the 2, which is the user value, and an 8-year service life. So we could plug that up and find the depreciation per year, subtract that from this item here, which will then give us the annual increase in net income, and then divide that by the average investment, which of course is 20 plus 2 divided by 2. So I'll give you a few minutes to sort that out, and then we will, I think we have time for one more question thereafter. Like I said, I know we started late, so if we have to go past 6 o'clock, if you all are able to, we could do that. Right? I don't want to deprive you all of the limited time we have left before the exam. cost was, sorry, am I blocking it? No, okay, good. Cost is 20,000. Residual value is 2,000. Estimated useful life in, whoops, sorry, years is 8. All right, so 20 minus 2 is 18. 18 divided by 8 is 25. No, sorry, 2250. Okay. All right, so the depreciation charge is 2250 per year. Right, so you're going to have to, again, subtract that from this item here. Need the annual increase in net income. 4,000 minus 2250, right? That's 1750. We have to divide that by the average investment, which is the 20,000 plus the 2,000, then divided by 2. Right, so equal to 20,000 plus 2,000. 5% coming on here. Okay, right, so that divided by that, and then of course we're going to multiply by 100. Right, there you go, 15.9, approximately 16%. Right, yeah. Yeah, so once again, let me just retrace that, right? So they wanted the calculation of the accounting rate of return. The calculation of that, again, basically all we're doing is we're taking the profit of the annual profit, the average annual profit that this new investment gives us, and expressing it as a percentage of the either the initial investment, so how much the project's capital outlay, how much the expenditure is returning to us on average every year, as a percentage of that expenditure. Right now, the challenge we had in this question is that we had annual net cash inflow. So we know we had a depreciation element. So we first had to calculate depreciation. And then we had to adjust the net cash inflow for that depreciation by subtracting the depreciation away. That gave us 1750. Right? And then we have to divide by the average investment. So again, sometimes they'll tell you average, sometimes they won't tell you anything. If they don't tell you which one to use, it's up to you, right? I would say if they give you a residual value, use it to find average. If they don't give you one, then just use the basic investment, right? Because if this was 20,000, right, we have a smaller ARR, right? Because we have a, what you call it, a residual value, we ended up getting, well, the average, of course, is going to be smaller than either of them. The average can never be bigger, right? It could be equal to one of them, but that is unlikely. Usually with just two items, right? Unless the items are exactly equal, but different story. All right, so that's the ARR, 15.91%, approximately 15%, or 8.75. If you use the 20. All right, cool. If you guys are good with that one, give me a G. If you need me to re-explain any particular part of it, give me an R, right? Which is not a problem. Like I said, I know we had lots of moving pieces for that item, so I understand if you need to. Oh, that's my beautiful wife online in the chat on TikTok. Hello. How are you? Can't wait to eat the food you cooked. Hello. 41486. Okay, cool. Lovely. All right, guys. So we have one more question to go for today. I didn't plan to do a whole set of stuff initially because it's a new topic, right? I mean, most of you all probably have done this in school already, right? But again, I don't know how well you understood it, if you understood it at all, if you did it at all, right? But I don't usually like to overdo on the first day. Right, so straightforward. So don't worry about NPV, right? Right, so the Calgary Eskimos play in the Canadian Hockey League. Although the Eskimos will soon be moving to a modern arena, management is studying the possibility of expanding the team's facility to accommodate increased crowds. A 2.4 million expansion is planned that has a 200,000 residual value. So you see, they give you residual value. So for ARR, you probably would use what you call it, average investment, right? And will be depreciated by the straight line method over 4 seasons. So the same depreciation calculation from just now, which is the cost minus the value, then divided by the number of years, will be in play. Right. Information about the expansion follows. So number of seats, 2,500, occupancy rate 80%, ticket price $6. Class 2 seats, 2,000, occupancy rate 60%, ticket price $4. The team will play 50 home games each season. Total added operating costs per game are including depreciation. Don't gloss over it. So total added operating costs per game, right, are expected to average 11,800. All such costs except depreciation require cash outlays. So they want the payback period, and I also want the ARR. All right. So for the payback period, right. So we have some calculations to do here. So the first thing, so let's see if we can kind of structure you through this particular item, right? Okay. So to find the payback period, we already know the initial outlay, right? It's not average, it's just the initial outlay. We need now the cash, the annual net increase in cash. All right. So annual net cash flow or net cash inflow, right? So what we need to do is figure, okay, look, it has to lie somewhere inside it. So this little table here tells us how much money we get in, right? So for each game, right, we're gonna, so out of this 2,500 seats, we're selling 80% at $6 each. So it's 2,500 by 80%, which is 2,000 by 6, which is 12,000, right? And 2,000 by 60%, which is 1,200 versus 4,800, right? So you're gonna add those two and then multiply that by 50, because this is for each game, right? So you're gonna multiply that by 50 to find the total money coming in, and then you have to minus these costs. Total added cost per game. Okay, so what you can do before you multiply by 50, just multiply going across here, 2,500 by 80% by 6, and then add 2,000 by 60% by 4. Add that together. And then if you subtract the 11,800, you'll get the figure you would need for the ARR. So if you want to do ARR first, you could do that, right? Then what you would definitely want to do to find payback period, you want to find the depreciation, right? So of course, that's using the straight line method, which we know is the cost, the 2.4 minus the residual value of 200,000, then divided by the number of years, 4. All right. And then what do we do with that? We're going to add it back, right? So whatever you got as the annual, annual what? Increase in net income, you're going to add back the depreciation to get the cash flow. And you're going to use that to find your NP, the payback period. Okay. So yeah, like I said, so I could give you the 10 minutes because you might need a little more than that, to be honest. And then we'll go through the calculations. Now, of course, if anybody's lost, not sure what to do, where to start, let me know. I'll see if I can provide some more guidance, right? Sorry, Aliana. Unit 1? That already passed. This Terry David. Randy, no, I'm not Terry. Mr. David. But I do also like and teach maths and advanced in addition to accounting. See if I can get some of that stuff up and running for all you in due course, but a little challenging sometimes. Okay. So I'm just gonna put some structural stuff inside of here to help with anybody who may be a bit lost, right? Ask yourself, what am I trying to do? I need to find the payback period and the ARR. All right. So payback period. Okay. So calculation of payback period. So what do I need? I need now, based on what's going on here. So again, they presented all this information for context, right? So it's a hockey team and they operate out of a stadium and they make money by selling tickets. They have different types of seats. The occupancy rate is what percentage of these seats is usually sold out every game, right? So they're not selling all 2,500 class 1 seats or all 2,000 class 2 seats. They're selling 80% of that, 60% of class 2. The price for each one is this, right? Now, what I need is the annual net cash flow. Now, based on this, it seems to be constant, right? So the annual net cash flow, I need that. I'm going to need to divide that by the initial investment, initial outlay, right? Initial investment, right? Okay, so the initial investment is 2.4 million, right? 2,400,000. Oh no, I mixed it up. Sorry, this is supposed to be on top. My bad. Yeah. Okay. So yeah, sorry. I need to divide my annual net cash flow by that. Right. Yeah. Sorry. You almost was what craziness Chris doing going. All right. Oh. Okay. Let's so if we had the annual net cash flow, we could figure that out, right? Sorry, one sec. Right. So we need to find that, right? And of course, for the ARR, accounting rate of return, right? What we would need the annual increase in net income. We have to divide that by the average investment, right? So average investment. Right, so I'm abbreviating that because we could calculate that right away, right? The investment is 2.4 million, right? So 2.4 million plus 200,000 K, then divide that by 2. We can work that out, right? So that's 2,400,000 plus 200,000. One. Right. 1.3 million. Okay, cool. So to find these things, the annual net cash flow and the annual increase in net income, that's what we have a little more. Right. Okay, cool. So let's actually push that up. Push this up. Right. Okay, cool. So calculation of annual cash flow ticket, right? So the increase in revenue, right? So the inflows. So we have the revenue here, right? So the inflows from class one seats. We have 2,500 multiplied by 80%, by $6 per ticket, right? 500 by 0.8 by 6,000. We have inflow 2, class 2 seats. We have 2,000 of those seats multiplied by 60% by $4 per seat, right? Okay, cool. So 2,000 multiplied by 0.6 multiplied by 4. Right. So this is the inflow per game. Less the, what do you call it? Added operating costs per game, which give us as 11,800, right? So 11,800. Okay. So this here is the operating income per game, right? But now we have to add back the depreciation to get the cash flow, right? Right. So the depreciation is the cost, 2.4 million minus the usually by 200K, then divided by the estimated useful life, 4 seasons, right? So let's do that. 2,400,000 plus 200, sorry, minus. You add back the depreciation, you're going to get 15,000, right? And this is the cash flow per game, right? So this is per game here, and this is per year, right? Which is 50 games per year. So all we're going to do to find, so it's really only these 2 lines we need. As in this item here, this item here. Let me just check something real fast. I didn't get that. Hold on 1 second. Depreciation per year. Annual is 550. Oh, right. So 55,000. Now this is per year, right? Okay. So yeah. Okay. So we have a little issue here, right? Okay. No, not to. Just pull this across, right? Okay. So when you scale up the 5,000 by 50, so 5,000 multiplied by 50 is 250, right? Because it's 50 games per year, right? And now when we add this back, you're gonna get 305. What's going on, boy? Am I missing something? Okay, right. Cash-based expenses per year. Cash per game is 6. Okay, I have the 16.8. Okay, cool. I have the 16.8. The depreciation 11. Okay, cool. Sorry, guys, give me 1 sec. Hold on. 50 is the operating income per game. Okay, cool. The depreciation is that, so the cash flow. Right. That's per year. So if it's per year, 550. Oh, wait, hold on. 2.4 million minus 200,000. 550. There you go. I know something was wrong on it. It was the zeros. Oh my gosh. Right. Okay, cool. So operating income per game, right? Is that per year? Um, right? Yeah, I won't worry to put all these figures, right? But this was on a per year basis. So let me get for the person just in. Zeros, zeros had it in for me. All right, okay. So annual net cash flow was 800,000. So we're just gonna put that there. In missing a zero. Wow. Right, so that's in 3 years. And the accounting ratio, so the average increase in net income is 50, right? Uh-huh. Yeah, that's cool. I'm done there. So you're not gonna miss anything, but that's cool. So you could go ahead. Yeah, guys. Okay. Yeah. So everybody mix up with that thing there, right? Now, to be honest, most of these most of the Cape questions not gonna come this complicated with set of stuff to calculate, but it's not out of the realm of possibility that it could come like that. So you have to know how to put together the information to be able to get what it is you need, right, out of the question. Right. Okay. Cool. So I want to send a couple of pics in the chat. That's the question. This is the specific answer, as in just the two metrics we're using, and then we have the what you call it. That's not what I want. Whoa, what went on there? Okay, cool. Right, so we calculated the inflow per game minus the cost per game. That gave us the operating income. We then scaled it up per year. We added back the depreciation, and we got the cash flow per game. Sorry, cash flow. Right, and then we use the appropriate figures and the appropriate formula on top, and we were good to go. All right, so folks, that's about it for today. All right. Um, like I was saying, and before I forget, just wanted to remind you, right? So we are here on the Tuesday. We have class same time on the Thursday. I will send a poll to ask if you'll want to just continue on the Friday or if to push that class to the Saturday usual time. You will tell me. Next week, Tuesday and Wednesday, I want to have some sessions, some final sessions, because of how the exams fell. I'm not going to be able to put you all here, or it'll be very difficult, right? So rather than try to do a kind of patchwork schedule and clash with other things, let's just put everything up front, right? These sessions will be costed as May sessions as opposed to April, right? Because already, I mean, if you count the number of sessions, we got one, so we got on the 5th, the 12th, right? So as of last week, we had 4, and this week will be 3, so that's 7 sessions, right? And maybe we'll do a session here and a session here. That might be 8, right? But even if we leave it at 7, that it's supposed to increase the cost, but I won't. All right. But I definitely cannot add 6 more sessions on at no increased cost, right? So I will cost these at the usual 400 for me, and then if you all want to have sessions for the multiple choice, we will cost those for June, even though they will be held in May. All right. I will message everybody. I'll message you all, say that, and you'll have to pass it on to your parents for me. All right. I don't have everybody's parents, but I'll pass it on to whoever I do have. Right. So we almost there, right? So just had to keep pushing. Anyhow, guys, I had to make a move. So thanks for joining. See you guys next week. Sorry, on Thursday. Bye. Uh-oh.